Hi everyone, welcome to today's video. So recently a decision has been made, and as per this decision, several Adani stocks are going to be added to 14 NSE indices. Now this is causing a lot of commotion. A lot of financial experts believe that this is a really bad move and people are up in arms. So from that perspective, you need to understand a little bit of background story here, that first and foremost, index investing is considered to be one of the most risk-free way of making your investments in the stock markets. For example, even in the celebrated book called as Psychology of Money, the author has recommended people that you should go and invest your money in indices. If we talk about one of the most celebrated investor, which is Mr. Warren Buffett, he has also given the viewpoint that index investing is actually a very useful form of investing. Given all these positive sentiments, a lot of investors in the US, they have moved their money over a time from active source of investing to passive source of investing, that is index investing. In fact, to add to that, similar trends were being seen in India, that a lot of migration was happening to these index funds. Now with this new announcement, it becomes very important for us to understand as normal common retail investors, even if you have zero interest in terms of direct stock picking or direct stock investing and you usually take positions via mutual funds, this video becomes extremely important for you to understand, because no matter whether we are managing our own money or whether we are giving our money to mutual fund managers to invest, it is our responsibility in a way to understand where our money is going. So please watch this video carefully, make notes, share it with your friends. That will be my humble request. I will explain you the entire fundamentals of index investing and how this recent decision by NSE is going to change the Indian stock market investing game. So let's kickstart the video. Also, there are no sponsors on this video. If you want to support the channel, do check out my course website, which is called as Wisdom Hatch. We are launching some really interesting courses. One of the most useful courses that we have launched is around stock investing. We have received excellent feedback from the community. In fact, I'm creating an entire app based on that course where an entire investment community will be able to engage, interact with each other. I am currently posting almost every day whatever moves I'm making in the stock market, be it buying stock, selling stock, what exactly fundamentally is happening. I give very quick commentary on that community. So this community is a free add-on to that entire course. So do go and check it out. And with that said, let us kickstart the video. Now let us first and foremost quickly understand what is the meaning of index. So index in very simple term means that it is a unit of measure, so to say. For example, if you have to figure out that how much garmi it is, then what are you going to check? You are going to check the temperature, and that temperature becomes Celsius, right? So in India, we measure temperature as per Celsius. If it is 45-degree temperature, like something in Delhi NCR, then it is fairly hot. If it is like -1 degree, something like Shimla or Manali, then it is fairly cool. Similarly, in the stock market also, we have these reference point called as indices. Now in India, there are various types of indices. For example, one of the most popular index is called as Nifty 50. Now this is the collection of top 50 companies by market weight. So you will have companies like HDFC Bank, fairly big company, Reliance, TCS. All these companies make a part of the top 50 stocks in India. And if you go and make a briefcase of these companies, then it is called as Nifty 50. Similarly, another popular index on the rise is called as Nifty Next 50. So this comprises of companies which are ranked from 51 to almost 100, and this becomes another type of index. Then you have something called as Nifty Bank. For example, this would have companies like SBI, it would be given a certain weight. You will have HDFC Bank, you will have Kotak Mahindra Bank. So all these banks, if you go and create a briefcase, it becomes an index. Same goes for Nifty IT, and there have been a bunch of categorizations that have been done. So to cut the long story short, in India, we have a bunch of indices. So I hope this first point is clear, that what exactly is the meaning of index and how many types of indices are there in India. Then comes the second natural question, that okay, why is it that index investing is getting more popular with time? And is there any specific advantage to index investing? Now, I don't want to make this a basic video. I will discuss the news item that I have to talk about, the Adani piece, but this important basic information needs to be given. So I'll be quick here. See, basically the reason why index investing has grown in popularity is very simple, and you need to think about it from simplicity point of view. So the first key reason is that index investing is simple. For example, if you do not know much about stock picking, you don't want to spend too much time in it, then what are you going to do? Most likely that you will simply go buy Nifty 50 companies. Now with what psychology will you be investing in it? You will be investing with the psychology that I don't know much about stock picking. If I'm investing in this Nifty 50, then I'm getting exposure to top 50 companies in India. And that philosophy is absolutely right. Now let's further delve deeper into that psychology. When you're saying that, you know what, I'm getting exposure to top 50 companies in India, what is it that is going on in your mind as a layman? most likely your thinking as a beginner is that okay, top 50 companies मतलब अच्छी companies, for example TCS हो गई, for example HDFC Bank, all these are good companies, and worst case scenario ठीक है यार बहुत ज़्यादा return नहीं मिलेगा, I am not taking exposure to small cap, mid cap, फुद्दू companies and all that, I am investing in top companies, so I will at least be able to preserve my capital. And if I keep on doing this Nifty 50 investing, it's very simple to do. Number two, the commission charges are very low. And number three, if I take a look at the 20-year historic CAGR of Nifty 50, it comes out to be around 12%. So my money has grown in Nifty 50 at a rapid pace. So analyzing all this piece of information, you will get very impressed that okay, this Nifty 50 is a good, sensible, safe-ish instrument. Same goes for Nifty Next 50. You will see that okay, fine. यार बड़ी कंपनियों में I have invested. Now let me go and take a little bit of risk. But these still remain the top 100 companies in India, so to say. So maybe investing my money here is sensible. Now third, you will think of it in a similar way that okay, Bank Nifty में if I'm taking exposure, then probably I'm getting exposure in the best banks in India. So that is the philosophy with which people invest in index. This is something that no one is going to explain it to you. But I hope that you understood this subtle point because this is where the story gets shaped up. So let's move over to the story with Adani's as to what is happening and why so much hoo-halla is happening in the market, because Adani stocks are getting imbibed into this index. So in regards to the Adani stock, what has happened is that NSE has decided to include several of the Adani stocks to several new indices and old indices. So approximately 14 indices have been defined where Adani stocks will find certain weight. This includes Nifty 50, this includes Nifty Next 50, this includes Nifty Top 100. So I will take you through the list in a minute, but let me quickly explain this entire piece without making it controversial. So basically what happens is that NSE does a semi-annual review of the entire indices that are present in India. They define and develop a certain methodology. They will say that, for example, Nifty 50, if I have to define a certain company, then the criteria of defining it could be market cap. Plus, there will be criteria too that needs to be met. Third criteria should be something. So whichever company meets this list, it ends up becoming a part of Nifty 50. So till here, the story is fine that okay, automatically they are creating some methodology and जो भी उसमें list में आता है, that becomes a relevant company for that particular index. But the problem is that new indices can also be built. For example, most of us would not have heard of an index in India. It is called as Nifty Sharia 25. So have you heard of it? Honestly, tell me and take a look at the methodology of developing that index. So these type of methodologies can be used and new indices can be built, and a lot of companies can find their place in these type of new indices. Now to understand part 2 of the problem, you need to understand how active investing works versus passive investing. And to help you wrap your brain around it, let me use some practical examples from this list. So here is a list of mutual funds that have exposure to Adani Group stocks. For example, you will see some of the mutual funds as Edelweiss Arbitrage Fund Regular Growth. And if you go and compare it with something like Nippon India ETF Nifty 50Bs. Now, you might say that you know what, this fund 1 and this fund 2 both have exposure to Adani stocks, and the fund manager is making an arbitrary decision in terms of investing in that. No, so a bunch of mutual funds work very differently. For example, Edelweiss Arbitrage Fund is actually an actively managed mutual fund. So actively managed simply means when the fund manager, let's say that you pay them 1,000 rupees, they will take that money and then they will make a choice whether to invest in Adani stocks and bunch of other stocks or not. So they get a choice that whether they should be investing in Adani stocks or not. On the flip side, when it comes to these Nifty 50 type of funds, then here the fund manager does not get that choice of investing in Adani group of companies. It is automatically designed that way. Why? Because here you are giving the fund manager and telling him that you know what, here is my 1,000 rupee, take it and go and invest in Nifty 50 companies. Now, if Adani Group makes a part of that Nifty 50 companies, then automatically your money gets invested into Adani Group. So just to recap this major problem, what exactly is happening is that see, NSE has built a bunch of indices. And many of the novice investors are what they are thinking that, okay, you know what, if I go and pick something like, let's say Nifty 50, or if I go and pick Nifty Next 50. But unfortunately, what ends up happening is that your money gets passively invested into certain companies where you might not want to build any positions. So this becomes a slight issue. Now you might give me a counter argument that, okay, NSE, BSE might be aware of it, SEBI might be aware of it. They might be doing something to counteract this situation. Well, unfortunately, the way the Adani story has played out, it is not as if that NSE, BSE, SEBI are not cognizant of it. But actually what has happened is that this methodology of building new indices and giving Adani companies weight into these different indices, this evaluation was done as per last month's data. But this month, unfortunately, Adani stocks have fallen by 70%, 80% also. So therefore, people are building pressure on SEBI, NSE, BSE that, you know what, you should probably relook into this entire redefinition of these different index funds. Now, whether they will act, whether they will not act, this remains to be seen, but we need to be cognizant about all the problems that this new situation might present. Now, the second key problem is that some index funds can become really bad, and you need to actually put your brain behind it and understand how every index fund is functioning. And many of the beginners do not understand this point. So let me outline it by using two examples here. For example, consider Nifty 50. Now, let's imagine that Adani Enterprise is a part of Nifty 50. Now, if Adani Enterprise falls in market cap or market value, then by next evaluation, this company will go out of Nifty 50 and some new company which has more market cap or market weight will find entry into Nifty 50. So I hope this point is clear about the nuance associated with Nifty 50. So Nifty 50 is somewhat of a decent filter. But on the flip side, consider for example Nifty Next 50. Now here what is happening is that the company is ranked between 51 to 100. Now imagine if three companies are there in Nifty 50, right? Nifty 50, they fall, right? And they are falling, they are getting crushed. Where will they find place? That some company is, let's say, at rank number 31, 35 and 45. Now they might all fall because market cap is falling and they will take entry into this particular index. Now here, what are you theoretically doing? You are actually trying to catch a falling knife. You might have heard of this phrase in the stock market that don't try to catch a falling knife. But exactly by investing in this type of an index, what are you precisely doing? You are trying to catch a falling knife. So this is what is automatically happening without even you realizing it. Now, I can't take you through the basics of all the index funds that are out there, but I have drawn a chart here and you can save it and probably research more about it. Where is it that Adani stocks are going to find more value? For example, Adani Wilmar is a part of Nifty Next 50 and Nifty 100. Adani Total Gas is a part of Nifty Sharia 25. Adani Power is a part of 10 different indices. Adani Enterprise is also a part of Nifty 100 Liquid 15. And you can read all these basic points and it will actually make you a little bit worried when it comes to index investing, and rightly so. Now, the third final problem in terms of bad companies finding place in indices is that it leads to index management. Now, what is the meaning of index management? To explain that, let me take you to Nifty 50 chart. So here you can see the last 1 year performance of Nifty 50, and what you would notice is that it goes up, it goes down, it goes up, it goes down, it goes up, it goes down. It is going up and down in a certain cycle, so to say. Now, what you might have noticed is that, you know what, banks are generally going down, even big banks. Almost all major sectors are going down, but Nifty tika hua hai. So that simply means that there is something called as index management that is happening. The meaning of index management is that index will dance in a certain range. Now, why is this such an important point? Because imagine this, that if, for example, Adani stocks are falling and index also falls from 17,000 to, let's say, 15,000 or 13,000, then what do you think is going to happen? Well, COVID-like market panic can happen. A lot of heat will be faced by current setting government. A lot of problems will be faced by them. So market management needs to be done, and there are something called as market makers. So market maker simply means that, for example, when other people are panic selling during COVID times, a lot of people sold everything literally. Then someone needs to buy, right? So you have organizations like SBI, you have organizations like LIC. So they become prominent market makers. So this mechanism is not bad. The index actually needs to be managed from time to time in order to avoid mass panic. But here is the problem in terms of incorporating bad companies into index. Now imagine a scenario where fundamentally weak companies are a part of Nifty 50. Then what needs to be done? Well, then in that scenario, market needs to be artificially kept alive. It needs to be put on a ventilator, and just so that panic nahi ho, isliye you know what, market needs to be supported, index management needs to be done. What I'm simply trying to say, and I hope this point did not become complicated, that index management is not bad. Sometimes the market overall fundamentals are such that people need to step in or governments need to step in and manage the market. Nothing wrong with it. But if as a system, your top index, which is Nifty 50 index, ends up imbibing a lot of bad companies for whatever reason, then the market needs to be artificially artificially supported. So this is the precise problem that I'm trying to tell you, because what it does in the long terms is that it makes the market fundamentally weaker. So these are three specific problems that I see playing out in this entire scenario. And now comes the natural question that what is it that you should be doing as a stock market investor? You should be doing index investing, not doing index investing. So here is my viewpoint on it. So point number one is that if you're doing index investing, it is not buy and forget investing anymore. Because right now the markets are being artificially kept alive, one could argue, definitely. Now, when in a bull run scenario, what is going to happen? That in the bull run, the individual stocks are going to give more run up, which are fundamentally strong, but bad stocks will suffer more. So in such circumstances, the chances of Nifty 50 doing a dance like this in a certain range becomes much higher. And as a Nifty or index investor, you are not going to make much money. So this is becoming a fundamental problem, because fundamentally bad companies are becoming a part of index. So this is the overarching perspective that develops. So this is point number one. So in this regard, what you should definitely do is that whenever you are investing in Nifty 50 or any index, have a very clear exit target. Now, what do I mean by that? So this is a post that I made on the member community tab of YouTube and on the Wisdom Hatch community, that hey, I had purchased index Nifty 50 here. My first clear sales target is with a gain of 5%, and my second clear sales target is somewhere around 9.5%. I had explained the entire rationale of this move in the member community. Now you might agree, you might not agree with my viewpoint. There are pros and cons to it, but to cut the long story short, whenever you are taking entry into a particular index, have a very clear viewpoint as to when you are going to exit and why. Third key point, please avoid indices where you do not know what the back end of the index is. For example, I gave you the example of Sharia index. You might not understand it. So please go and read through the methodology. So this is what the index methodology looks like. Now, if you understand it, please go and build a position. No doubt about that. Also, avoid investing in a bad index. For example, fundamentally speaking, that Nifty Next 50 is generally not a good investment instrument for normal retail investors to chunk their money into. So this is what my point of view is. I've explained you the rationale earlier. Now, if you feel otherwise, definitely go and build position. No doubt about it. Now, then comes the final point, that going forward, if something becomes a system, for example, if retail investors are generally putting more money in index funds, what do you think is going to happen? Have you seen retail investors ever make money sustainably in any particular asset class, in any particular field? The answer is no. So you tell me what is going to happen to index investing and what is the future of index investing in India. So from that perspective, if you're smart enough to pick this particular trait, then you must understand that at some stage you need to graduate from index investing over to individual stock picking, or at least understanding how to time the index intelligently. So these are the key central points that I will leave you with. I hope you enjoyed this video. If you did, do press the like button, share it with your friends, and I will see you soon.